Yeah, forget about it. Forex.today. Thank you, Forex.today, for hosting our webinar. Let me remind you that trading is risky, not appropriate for everyone. You can lose money, yo! Your past performance is not indicative of future results. Could have been a hero yesterday, but a zero today. Therefore, it's pretty wise not to risk money you cannot afford to lose. It should be risk capital. I've always said over the course of, 10 or more years of doing webinars like this, that you should stay small, stay humble. What does that mean? Focus on the long term. What does all that mean? Early in my career, I actually sat down and did pro forma cash flow statements on my projected earnings from trading. I know, sounds silly. In fact, I did a business planning retreat with myself and spent probably 2 days on Excel creating these pro forma cash flow statements, projecting out my performance in advance, and found out, and I didn't go into the exercise with this in mind. It's what happened. The output showed me that I didn't need to gamble. I didn't need to place large bets in the market to achieve my goals. All I had to do was achieve the humble daily sort of average. And over the course of 2 years, because that's what I did, 2 years of cash flow statements, that I would hit my financial goals easily. And that there was absolutely no reason in the world for me to bet big on a particular trade or on a particular day or even a particular week. It just really didn't matter in the long run. What mattered is that I didn't blow up my trading account, because if I lost half of my account, I would have to double my account to get back to even. So at all costs, I had to avoid that. And as long as I met my small, modest daily goals, the course of 2 years, compound interest takes care of everything. So that's why I say stay small, stay humble, focus on the long term. It's something I learned pretty early in my career. And boy, I'll tell you, it takes a weight off your shoulders. It was almost like a sense of freedom, like a weight had been taken off my shoulders, and I could go, oh man, that's awesome. Hey, Nabil. Okay. Hey, my name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that offers traders Forex, but also access to energies, metals, and indices, which is really important if you're doing global macroeconomics, because it's a giant money machine, right? So you'll see, like, let's say Brent and WTI go up. What happens to the Canadian dollar? Goes up. Well, why would, if it's a demand side of the equation, if demand increased the price of energy, Canadian dollar goes up, but what created that demand? And you'll find that there's going to be another currency that's being affected by that. Also, another thing that could happen is the US dollar could fall, right? Which could make energy prices go up because they're priced in dollars globally, and the CAD will look like it's going up, but it's just going up relative to the US dollar. And why is the US dollar falling? And maybe it has to do with stock indices. And so if there's been a change in trend, How do you get into this trade if the market's been long for, let's say, months, and all of a sudden it's reversed? How do you take that early trade, that sort of higher risk trade in the change of trend? You might want to hedge the cash position using a binary option, because you have limited downside in the binary and unlimited upside in the cash. Plus, if you're trading in the direction of a carry, meaning you're actually being paid for a yield, positive interest rate differential, that you're actually getting icing on your cake as well. So that's why TradersWay offers all these things to a trader, because a lot of these things, well, I would say they're all critical to your long-term success. If you watch these videos on YouTube, if you're watching the recording, of course, you can just on YouTube search for Forex Today, and you'll get our daily videos. Please subscribe. Would you do that for me? Wyatt, they're going through an upgrade, so I don't have an ETA for you. In my experience with all companies around the world, if the tech team says it'll be done in March, it'll be done in August. Right? Because you got to hire the Indians to do the coding, then you got to hire the Russians to do the QA. So it takes a while. All right, so these webinars are hosted live. Hey, look, we're live. Hey, yo. These webinars are live at Forex.today. If you would please, at that website, go ahead and register. And one of the things you'll notice once you register is a chat room will pop up, and the community of traders, and that's everybody here in the live webinar, will be able to collaborate throughout the trading day. Cool, huh? Also, in this section here, you'll see webinar videos, and then you'll see up here, these webinars are also archived every single day. So you can go in, if you miss a webinar, you can, you can catch it there. And also, on any given day, when you log into Forex.today, you may notice that there's at least a dozen trading ideas that are documented and laid out with charts and descriptions and all that for you. So it kind of gives you a leg up the market, moves you toward being smart money. Cool, huh? Yeah, YouTube has been having problems, guys. So yesterday's video had errors on it. I noticed that when I tried to, well, the day before's video had errors on it. So I uploaded yesterday's video yesterday and then re-uploaded the previous day's one. And the previous day's one was fine, but then yesterday's was messed up. So I don't know what it is. It's YouTube. So I don't know, short sell some Google stock or something. So I apologize for that, but it ain't my fault. All right, so British pound. We've been short British pound for quite some time. Just to remind you that it's a long ways down. And even though the technicals, suggest that this could head down quite a bit, down to 136, we've been saying that I don't actually think that that's going to happen. But what we have to do is line up the technicals with the fundamentals, and what we're looking at here, and what we've already discussed, but it's important to revisit, is that you're lining up Bank of England policy decisions, right? And based on fundamental analysis of things like how GDP is actually calculated and when the GDP is actually released, I've shown you that I believe in the period of somewhere around, January to March, so let's say first quarter of next year, the Bank of England will surprise everyone and raise interest rates. Well, we're not in January, February, or March, are we? So what happens is you get your little pause in this down move. So you get some green candles. Why? Well, maybe because somebody thinks maybe perhaps the Bank of England's going to raise interest rates. Or more likely, traders are short and think, well, maybe this is a good opportunity to take some, risk off the table. Does that make sense? So it's kind of like after non-farm payrolls, euro's going up and nobody's buying euro. Well, here maybe nobody's actually buying the British pound. They've just taken their profit and it's fading and fading and fading. Now on this daily chart, or if I go to the 4-hour chart, we run into some key levels of resistance and moving averages. Okay, now I believe it was yesterday or the day before we talked about if the 55's in control, we're vulnerable to a double bottom, right? Everybody got that part? Speed of the market's still technically bearish, but the market has slowed down. You adjust your expectations accordingly, which is very important to a trader. And you say to yourself, slow down, I think we're vulnerable to support, where when the 21 was in control, we were not vulnerable to support. There was no support. As far as we're concerned, this could drop 1,000 pips. We're aggressive. We're confident more. Said better, we're confident. Well, as soon as it pulls back to 55, you say, whoa, whoa, whoa. Okay, I'm still a bear, but that was a giant pullback. And if we're so bearish, why did we need such a pullback? So now you say we could be vulnerable at support. So anyways, it comes down to support. And like the 55 would suggest, failed to make a lower low. Great. So when the 55 breaks, which occurred here yesterday, what was our target? What did we clearly say? If this breaks above here, where is it going? Based on moving average theory. To the 200, right? Remember me saying that the 200 EMA is a target but not an entry? Let me clarify what that means. It means that the 200 EMA represents fair market value. This is where the bulls and the bears agree. Now, we don't know, once they agree, who's going to take charge. A bull could just as easily take charge as a bear. So at best, your odds are 50-50, right? I don't like those odds. Right? What is Gordon Gekko like? I like a sure thing, kid. Get me some information I could use, sport. So anyways, it comes up to the 200, and that the market, the way I measure it, is neutral. So now we're waiting to see the bulls and the bears. Now, what's interesting is we're neutral when the Bank of England releases its decision. Isn't that interesting? What an interesting time for this moving average theory to suggest we're neutral when the market really is neutral, isn't it? If the Bank of England raised interest rates, the bulls would have taken over. But they didn't raise interest rates, so the bulls are out, the bears are back in. No longer neutral. Now the funny thing, funny how, like a clown, is we're in that direction long term anyways, right? Okay? So anyways, we're back into this area. How would you like to play it, sir? Now, can you see that I've already drawn it out? Was it Tuesday I did this? Well, maybe not. Maybe it was yesterday. 1, 2, 3, 4. I guess it was yesterday. This was New York. I suggested we wouldn't get beyond the purple area. I have an orange line to suggest resistance. And I've drawn out that on the long term, this should come down. Right? Well, medium term. And on the short term, that it would work its way down. Then it would work its way up, which I think it kind of did, right? It was down for about 9 minutes. Look, this, can you see that? If I zoom in, it'll probably mess it up. Look, I have it coming down here. Can you see the wick? I mean, it's not that far off, is it? Down, Then I said it would go up, so it went back up into resistance. Then I have it coming down. Well, what happened was it went up and it came down a little bit, but we're waiting, right? And then what? I thought maybe it'd come up here, but whatever. I thought it would go a little higher earlier, people front running. But nonetheless, the longer term, we want it to head down. How cool is that? So now you drop into a smaller time frame. Okay. In here, you see there's a little opportunity. Down, 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 up, up. We might want to look at this. Maybe 5-minute chart's too slow. Okay. Okay. Thinking ahead. That's called trade planning. Okay, we're back into the old pivot zone. Okay. Look at this. Down to the weekly R2, hesitate. Down to the monthly pivot, hesitate, right? So weekly pivot, monthly pivot. What do you think? Down here, will it hesitate? Yeah, probably. All right. So which one would have been aggressively entered by traders? How about the beast? The pound yen. All right. Let me try to figure out what was the projected target for the week. That's the projected target, that red zone. Do you see something interesting? Within 1 pip accuracy. Now let me ask you something. When you see this, and this is important, you literally have to think the question to yourself, and then you literally have to answer it to yourself. Do market participants use weekly pivot points when trading the pound yen? I would like you to answer it. I'd like you to think about the answer. Then I'd like you to think about how to type the answer with your keyboard. And I'd like you to reach out to your keyboard and type it out. No, actually type it out. Yes, market participants use weekly pivot points. Now you're going to have to think about it because you have to actually type it. It's a tactile thing. It's a language thing because you have to translate your thoughts into letters and then remember how to actually type the words in English. It's all very important because what you're doing is you're filing the knowledge away at in different locations in your brain. When you see it typed out, it's a visual thing. When you're actually typing it out, it's a tactile thing. It's a language thing. It's probably a translation thing. If English isn't your first language, you're also thinking it and you're thinking about it, and then you're visually looking at the charts, and you could possibly remember this. And so if you just follow those 3 basic rules, I'll guarantee you make at least $1 million a year. You can't skip 1 or 2 or 3. You have to do all 3 completely. Any questions? Yeah, I'm sorry, my internet went down, but luckily I have another internet. Yes, so I have 2 redundant internet connections. Both are extremely high speed, and it's specifically for this situation. You can't hold me down. Isn't that great? Right, this is why I spend $400 a month on internet connection. You can't hold me down more than 3 seconds. All right, so thank you for your patience. Yeah, well, I'm in the United States of America, greatest country on earth, slowest internet on earth. Yeah. That's how we do it, yo. Oh, you lost, I think you lost camera again. Hang on. Now it's the software, so the software freaks out because, the screens went down. Hang on. I don't know if I can even kill that. Let's try this again. You know what also bewilders me? When Microsoft or Windows wants to install something, for some reason, it wants to turn all your monitors off and then say, "Are you sure you want to install this? Click OK." But why does it have to turn all the monitors off? Well, when you got 18 screens, sometimes that's a problem. It freaks the other software out. You have to get my attention. I know I'm installing the software. I don't need but whatever. How silly. All right, so I think we're back in action. Is that right? Cool. All right, so these gray boxes you should see are pound Aussie. And these are buy zones. I hope you bought them. Yeah, it's a trick though. It's these are weekly candles. So in here, this was where Governor Stevens at the Reserve Bank of Australia told the world that he believes, and this is the guy that actually sets the value of the Aussie, he believes the Australian dollar is overvalued. So pound Aussie starts going up. In here, this was 2014, summer of 2014. It was a warm, rainy night in Tokyo. And the IMF through the WEO, the World Economic Outlook, upgraded their forecast for the UK economy, and then British pound got strong. And Aussie obviously stayed weak, and you get these beautiful rallies. So that being said, did anybody read the new WEO? Was it yesterday or the day before? I think it probably came out Tuesday. That's right, I was in class, so it's Tuesday. Joseph wants to know the 3 rules again for guaranteed to make $1 million a year or more. I was joking, because I knew I lost internet, and I knew you lost me, obviously. Yeah. So Sean started reading the WEO last night. That's cool. Look, if anyone guarantees you $1 million a year following 3 simple rules, they're probably in the business of making $1 million a year selling you the 3 rules. Yeah, Wyatt, I'm Canadian, and we have a very dry sense of humor. My entire family in Canada are a bunch of comedians, which is not unusual for Canadians, but you would never know it. And then you realize that they're pulling your leg, and you're like, you know? So it's just funny. I mean, so anyways. That's what happens when it's minus 41 Celsius. And dry as a desert. So anyways, that's that. Pound dollar, I think we covered. Pound yen, we've covered. Pound Aussie, interesting stuff, right? Next week, we might be visiting the 21 EMA. Are you going to eyeball it for maybe a long in the next week or two? Yeah, the next week or two. Amazing, huh? To think that far ahead. Okay, so British pound, decide what you want to do. Yeah, just decide what you want to do. Don't get caught up in the short-term noise of things. I think we're all waiting for Europe, but we've discussed that quite a bit. So let's see. Oh, it's funny. I loaded my charts opposite. I gotta be careful. All right. So in some cases, the yen is. So let me show you that. Hang on. Where's my mouse? 18 screens. There we go. Guess we'll look at it this way. Life is very hard. All right, so it seems to me that euro yen is coming down. Okay, let me zoom in on this a little bit. Seems to me pound yen's coming down. What about Aussie yen? What about CAD yen? Do we have across the board congruency? No, we don't, do we? So we're selling off the European currencies. Where's that money going to go? Well, it's either going to Japan or they're paying off their Japanese loans, right? Let me get this set up a little bit better. Or maybe that money's coming to the United States of America. Let's see, let's change this to a 15-minute. Life is very long. Very interesting, huh? Because let's look at this. Aussie, very little effect, huh? So I think the Bank of England is going to continue purchasing bonds. I believe the European Central Bank are going to continue buying bonds. I believe the Bank of Japan is going to continue buying bonds. In fact, we're going to get a surprise announcement in 3 weeks, which we talked about 3 weeks ago, but we're going to get a surprise announcement in 3 weeks by the Bank of Japan on October 30th that they're going to increase the amount of bonds they're buying. How nice is that? So some of these things are kicking together into play. We're at the bottom of our range for the USD yen. We've been at, 120 has been an issue, and then of course 119 is even better. But we're on the lower end of things, aren't we? And you notice that we came down to the weekly central, and that's holding. And if this decides to go up a little more, right? If this decides to go up a little more, then we'll be back above the monthly central, and we'll look at this whole area here, really, as being the actual support, right? The cluster of weekly and monthly central. So we'll see how that plays out. But I would say generally it's at the bottom-ish of the range, wouldn't you agree? It'd definitely be a terrible place to sell. Okay. Well, that's important, right? A lot of retail traders will chase. So somewhere in the next 2 weeks, we should try to get long this in anticipation of the Bank of Japan's decision, right? Life is merry. All right, so dollar index is strong right now, and commodities are benefiting, or at least the currencies are benefiting from the additional quantitative easing or the continued quantitative easing in the global markets, which would be a stimulus which eventually, hopefully, should increase demand for commodities. So, CAD and Aussie, they're not terribly weak. At the same time, the dollar index is quite strong. So right now, it just looks like money coming out of Europe and out of Europe and the UK, and simply moving to the United States, maybe as a safe haven, maybe, right? And maybe back to Japan to pay off, the funding. So like if you were long pound yen, what were you doing? If you were a bank in the UK, you used your pound as leverage, right? As margin or as collateral, if you will. You posted your British pound as collateral to borrow Japanese yen. Now you have Japanese yen in hand, and a lot more because you're leveraged, at least 100 to 1, right? So for every pound you borrowed, you have 100 pounds worth of Japanese yen. And the interest rate on that is essentially 0. Not bad, free money, right? So now you take your 1.5 million Japanese yen, and you use that to purchase what? Anything, Aussie dollar or something, right? That's how it works. But you're funding the Aussie not with your British pound, but you're funding it with the Japanese yen. And you had to borrow it. You have to pay interest on it, but it's extremely low, almost 0. And if you put it into Aussie or Kiwi, you're getting almost 2%, right? The difference. That's the interest rate differential. So if for some reason you need your pounds back because they're going to lose value. You got to cash out of whatever you've invested in, pay back Japan. Well, that means you owe them, right? You owe them some yen. So what happens if, suddenly you need to buy some yen to pay off your loan? Well, the Japanese yen can get strong, right? And so on and so forth. And then you get, la-di-da-di-da. Nabil wants to do some Aussie yen? Yeah, we could do some Aussie yen. Is there any particular reason why? Now, if you're looking at the 4-hour 21, is it even on here? Yeah. All right. So we did this yesterday in great detail. Okay. One of the things that we're hoping to do today is predict where today's 5 EMA was going to be. We tried to do that yesterday. And I think what we were going to do is cut the corner on the daily and use the 4-hour 21. Is that right? If you were a bull on this, you'd buy the 4-hour 21? Yes, Ron says that's correct. Cool. So that would be your buy zone. Okay. Now, it's far from clear whether that's going to be success, right? Because I think you would agree that this monthly R1 based on price action has been important even in other months when it wasn't a monthly R1. Wow, look at some of this stuff. Let me clear some of this stuff out. Yeah. Yeah, very difficult. Okay, so you can see we have this marked out as an area of caution, right? Important area, 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 right? All in here, and we're there now. So if you're going to long bomb it, this is a great example. If you just need to get long on this, and you could argue all kinds of things, interest rate differential, Bank of Japan's going to increase quantitative easing, you're building a long portfolio on this as a carry trade, and it's worth the risk. This is a great one here. Let's talk about this. How do you enter a cash position like this? Well, if you can get long this and just simply not get knocked out, there's a couple of things. You're front-running possible changes in central banking policy. One would be the Bank of Japan actually increasing quantitative easing. And, we're not hearing so much out of Governor Stevens about historically overvalued Aussie dollar, at least now. And remember, the longer time goes by, the more the Europeans have the likelihood of seeing green shoots from their quantitative easing, which would then help China, which would then help Australia. So, Aussie dollar now, I'll buy it next summer, but at some point you may want to try getting in, right? But wouldn't you agree that this seems to be a bit risky to be long this on his sort of a, I don't know, just historical terms? Here, let me zoom back in. I mean, it's not bullish based on what you see here, right? But let's talk about being long here. If you get it right, and it goes higher than this and higher than this, you could be long for the next 5 years. right? Once you start to see green shoots out of Europe and stabilization in China, I would venture to guess that the Australian dollar will benefit from increase in demand for their commodities. So you're going to have to measure the balance of payments and balance of trade out of Australia, which is still a deficit. So it ain't happening right now. But in 5 years, let's say, I believe Australia will be running a trade surplus. And that means the Chinese economy is recovered. And if the Chinese economy recovered, it's because the European economy recovered, and so on and so forth. So in 5 years, I think all of that will happen. So do you buy it now, or do you, for 5 years would be too late? So it all comes down to a question of, do we get the global macroeconomics, and when do you actually enter the trade, right? So anyways, let's say you start trying. My number one rule when trying to build a portfolio is, besides trading in the right direction, is can you remove risk quickly? If I long this, can I jam the stop to break even so that I don't lose any money? And being long the cash means I have unlimited upside. In the foreign exchange market that we trade, I could be long this for 5 years. I could be long this 10 years. And 7 days a week, I'm going to earn interest on my leveraged money. It's really good. If I just break even pip-wise, let's say I never cash out a pip. Let's say I don't even intend to make a pip. I will earn 200% because I'm leveraged on the money that I've actually put in. So being guaranteed 200% a year on my money is pretty good in most places in the world. So, okay, I got a good trade I could be in, unlimited upside. I'm earning a positive interest rate differential, which actually really adds up. But it's a high risk trade rate. So the way that you can do this is then sell a binary option. Okay, it's also a leveraged position. Okay. So we call this short the option. And you long the cash. This is what hedge funds do, guys. Now you're hedged. And for just a little bit of money, consider the option an insurance policy. So if you jam a stop, I don't know, let's say 100 pips away, and the price comes down, knocks you out at minus 100, you've lost 100 pips on the cash. But you did have the possibility of unlimited upside. You had a limited downside of 100 pips, and if you do get it right, you will get paid interest on top of that. Pips plus interest equals icing on your cake. Now, in it right, for a little bit of money, you have this insurance policy, so that if price in the cash market does come down, knock you out minus 100 pips, about 44% of that loss will be covered by your win on the option. Now, the option is an insurance policy. You got to pay for it, right? You got to pay your premium. But you have unlimited downside. Well, you also have limited upside too, but we don't care about the upside. If things go right, your upside is your loss anyways. But all right, so you have limited upside, limited downside, but you know what you're going to make, you know what you're going to risk. You don't need a stop loss. You don't care about volatility. You don't care about timing. It all comes down to this option either expires worthless, so whatever you paid for it was your cost. But if you do get your cash position wrong and price does come down, knock you out at your stop loss, almost half of that loss will be covered by your win on your option. So now you have this aggressive trade in the direction of your long-term trend with unlimited upside and 200% interest on your money per year. And you're reducing your risk by 50%. Does that sound smart? No, Mike, you're not selling, you're buying an option that pays you money on the when price falls. Okay. So anyways, that's what a pro would do, guys. Find how you can get your unlimited upside, at the same time reduce your risk. The other way you can do it is just wait for this to be an uptrend and then buy dips. Right now, it's not an uptrend, it's a downtrend, so you should probably get some insurance policy. Now, do you guys ever watch the VIX? I taught you guys about the VIX, which is an index that watches S&P 500 traders buying insurance on their S&P 500. So when everyone believes the S&P 500 is going up, there's no need to buy insurance because everybody thinks it's going to go up. There's no need. Why would you buy insurance on something that you're extremely confident in? You don't see the risk. But what if there is risk in the market and the S&P 500 looks like it might come down or is coming down? Well, that's when people need insurance policies, and what they're doing is exactly what you see here. They don't want to get out of the cash position because they've put their cash into the S&P 500. But they don't want to get out of that. It's a long-term trade. Initial jobless claims 263, better than expected, guys. That's the big news. All right. So anyways, they don't want to get out of the cash position because they spent weeks or months or years building their portfolios. But they can see, obviously, the S&P 500 is going to come down today or this week or this month or even this quarter. A lot of investors are thinking yearly. They're not they're looking at monthly candles. They don't care about a bad quarter or even a bad year. They're like, it was down 10% this year, but it's still a good company. There's a lot of investors that think this way. So what do you do to protect yourself from the downside? Options. And that's why you look at VIX, because VIX, as I taught you, is a fear index. It's a fear gauge. And the higher the fear, the more the option trading because they're buying insurance. So you can trade like a hedge fund if you would like. So now you're learning how to hedge your cash positions for unlimited upside, lowering your downside by 40 or 50%, catching 200% or more interest payments per year, using option indexes as a fear gauge. And then yesterday we were reviewing again how to use the Fed Funds futures rate and pricing differentials between the months to look at probabilities of rate hikes at the central bank. My goodness. How does it feel to be smart money? Smart and good looking. Hey, Ron? Rare combo. Canadian housing price index, a little better than expected. It's just for new houses. Would have. All right. So what are you doing on the pound? Are you still selling the 1 minute? Right, the question here that I'm being asked, by the way, is it Chem? Yeah, I think it's Chem, right? Is that how you say it? Gem. Okay, Gem. Or is it, yeah, is it Gem or Gem? Gem. All right, cool, Gem. All right, Gem asks, how far, what option should we buy? How far out? Depends on the strategy, wouldn't it? Right? Are you going to be in the trade, well, when would you like your insurance policy to lapse? Is basically what it is. So if you're looking at a daily chart and it's already double bottomed and starting to head up, will you need a lot of insurance? How long will it take for that daily to fail, the double bottom to fail on a daily chart? Well, if it's going to fail, it's going to fail what? I mean, it's a double bottom should go up, right? Right? Let's agree on that. If you bought this, let's say, and you believe it's going to work its way up, it's supposed to go up. I don't need a lot of time. Okay? If I was buying this blindly because it was, let's say, some sort of support, like it is, actually it is here, weekly M4, I buy this blindly, well, I'm going to need a lot of time to work this out. But over here, the double bottom holds or it doesn't hold, so I'd need less time. Of course, that's a 1 minute, so let's not make a big deal out of it. But, okay? So it depends on what you're playing. Okay? Do insurance companies have their own traders or do they place premium? You know, insurance companies are bond companies, Ron. Okay? And that's all it is really, they're just giant bonds. Now think about it. You pay, right? You pay a payment every month. It's like a coupon payment on a bond. And so these insurance companies, they face two things. One, they have very long-term risk, right? Because you might buy insurance, let's say life insurance could be 50 years worth of insurance. Okay? That sort of thing. And then they have liquidity risk. So let's say a company in Florida is selling hurricane insurance. And they collect the premiums every month. It's golden, right? Awesome. Because they have 10 million people in Florida paying them premiums every month. And let's say a hurricane goes by, but not hit Florida, and there's some damage, 100,000 houses are severely damaged, and another 100,000 have some damage. They can cover those claims easily, right? Not a problem. There's more money coming in every month than going out. Easy. But what if one hits Florida, takes out 1 million houses and damages, a significant amount of houses? Well, the insurance company is in trouble now, right? And they might have all these people paying their monthly coupons, if you want to look at it like a bond, or they're paying their premiums. But so they're good for it on the long run, but on the short run, they might not have enough cash. So they have liquidity issues like a bank, because suddenly withdrawals are bigger than their cash flow, right? They might have paying assets, because these people, they're paying their monthly premiums. If you actually fix their house, they're going to like what they're paying for, and they're going to continue paying the monthly, right? So anyway, so then you have reinsurers, right? Which to me is funny, right? So you have insurance companies that only insure insurance companies, so on and so forth. But you can look at the thing as like a huge bond portfolio of short-term liquidity portfolios to pay out those that need the money, but then long-term bond portfolios to hedge the long-term exposure and so on and so forth. And it's all just comes down to bonds. So like borrowing your house, borrowing money from a bank on your house mortgage, right? That is a bond. Right? It's amortized. So you're paying a little bit of principal, you're paying a little bit of the interest, and over the course of exactly 30 years, at the end of it, you will have paid your principal and your interest. Versus a corporation might borrow money now by issuing money or issuing a bond, and you lend them $1,000, and every 6 months they pay you $50, and at the end of 5 years they pay you your $1,000 back. Or it could be a government that borrows money from you for 6 months, and right, they'll sell you $1,000 bond for $999.50. Therefore, you don't collect any interest, but in 6 months they'll give you $1,000, but you only paid $999.50. So you're going to make a whole whopping 50 cents, right? Or in that case, it would probably be what? $995. You right? But the government at the end of the, so they're all bonds, guys. This is why it's really interesting. What we actually do as foreign exchange traders is follow the money around the world based on bond trading, really, because you know you can lend New Zealand money, you can lend Australia money, right? How awesome is that? But you can increase your profits by borrowing money from Japan first. Right now, that's you have to pay them back plus interest. Just happens to be their interest is really low. And then you take that, and now you buy a bond from another country like, let's say, New Zealand, with the money you borrowed from Japan, with the money you used as margin or collateral here in the United States or wherever your local currency is. At this wicked transaction, right? US dollars as collateral to borrow Japanese yen and pay interest, and then you take that and you buy or lend money to New Zealand, and now they owe you money, and you owe right, they owe you money now, and then you pay Japan, and then at the end, whatever's left over gets converted back to your currency. And this is the interesting thing, is we have to follow really those three transactions. What's happening to the Kiwi dollar? Are people lending New Zealand money? Is it worthy of the investment? Risk and reward, right? And if so, that currency will, well, if you're borrowing Japanese yen and then selling it to buy the Kiwi, well, then the Japanese yen will lose value, which is fine by you because you've borrowed it, you have to pay it back, but now you get to pay it back with cheap yen. And then once all that's done, and you've collected the interest rate differential or paid the interest rate differential, and then enjoyed or did not enjoy the change in valuation in the Kiwi, or enjoyed or did not enjoy the change in valuation in the Japanese yen, once all that's said and done, it's all settled, profit or loss, then the whole thing's got to get converted back to your local currency, which can also affect the value of that currency, which we've seen lately a lot by watching currencies go up, but yet nobody's buying it. It could just be local conversions, so on and so forth. Very interesting stuff. Well, Ron, actually that's what we do. So, right, collecting the premiums. Well, what's your premium if you lent New Zealand money? You own the debt priced in Kiwi, so by definition you own the Kiwi because you had to buy the Kiwi to buy the bond. Okay, now remember the cash itself doesn't necessarily pay interest, but the bond would pay interest. Or if you put it in a bank account, in New Zealand, the bank would have to pay you interest, right? So however you want to look at it. You're seeing that interest every day, which is put into your trading account, which you can now reinvest. And if you get the trade right and the Kiwi appreciates and the yen depreciates, the Kiwi yen would go up, and the change in valuation, now the pips, if you will, that are paying you money are also marked to market in real time, and that profit is available to you in your account to trade in real time. Which in many or most other asset classes is not true. You might be rich on paper. How many people have heard of that? Millionaires on paper. It's probably the worst thing ever, right? You're dead broke, but you're a millionaire on paper. So then what do? You borrow money against this millionaire fake money, and then now you got real money, but now you actually own debt, and now you're actually negative $1 million. But anyways, so in most asset classes, let's say you have stock options, right? And you have $10 million in stock options. Great. So what? Now the worst thing is in the United States, they'll tax you on that, but you don't have the money. Oh, they'll still tax you. But whatever. In Forex, it's one of the only markets where you're not a millionaire on paper. You own $1 million worth of, let's say New Zealand owes you $1 million plus interest, and you owe Japan $1 million plus interest, but luckily the yen's getting weaker and the interest is basically interest free, and the Kiwi's getting stronger, so it's increasing in value, and you're getting paid interest, and it's mark to market in real time, which means the profits are already in your account. Right now, second by second by second, you're getting richer and richer, and it's liquid, baby. Right? Remember Gordon Gekko again? I don't mean a $400,000 a year executive flying first class. I mean liquid money, enough money to own your own plane. That's what I'm talking about. Fun stuff, huh? So now get out there and get your pips. All right, guys. Peace on earth. May the pips be with you. May your profits be above average. Is it Thursday? Yeah. I guess I'll see you over at fxstreet.com tomorrow. Remember, TradersWay wants you to open up a live account with real money. That's why we're doing this. Right? You're not getting, letters in the mail. You're not getting TV advertising and stuff. How is TradersWay trying to reach out to you as a potential client? We're spending time and money and resources and effort and passion and sweat and all these things to A, earn your loyalty, but two, give you the confidence and the skills for you to one day go out and trade real money and start a successful career as a foreign exchanger. What we're hoping, and I'm just going to tell you, what we're hoping to do is that you pay it back. When you have that confidence, you'll fund your account at TradersWay.com, and we'll be your trading partner for many successful and profitable years to come. And we'll work together on your career. So, peace on earth. May the pips be with you. May your profits be above average.